Hello, and welcome to the lecture on measuring production. In this lecture, I'm going to discuss the four components of GDP. I'm going to calculate nominal GDP, real GDP, and the GDP deflator. And I'm also going to calculate inflation using the GDP deflator. When we're measuring income of a country, we have two measures. The first is gross domestic product, and the second is gross national product. Gross domestic product is telling us about how much is produced within the borders of a country. So it does not matter where somebody is from, i.e. what their nationality is. Anybody who is producing within Canada's borders is producing to Canada's GDP. Gross national product, or GNP, is a measure of how much is being produced by certain countries' citizens, right? So gross national product is based on your nationality. So let's give a quick example. If you are a Canadian citizen producing in Canada, then you are contributing to Canada's GDP because you are in Canada while you produce. You are also contributing to Canada's GNP because you are a Canadian. If, on the other hand, you are a Chinese national living in Canada and producing something, in that case, you are contributing to Canada's GDP because you are producing within the borders of Canada, but you are contributing to China's GNP because your nationality is Chinese. In this course, we are going to look primarily at GDP for our calculations. Right? So we do need to know the difference between GDP and GNP. However, our calculations will be GDP. So let's look at the definition of GDP. Your textbook goes into each of these components in great detail. I'm going to go through this as well in a reasonable amount of detail, but I encourage you to also review the textbook. So here's our definition. GDP is the market value of all final goods and services produced within a country in a given period of time. So we've got the market value. The market value is the price of the good or service multiplied by the quantity of that good or service. Now, this price can either be a constant price. This is how we would get real GDP. Or it could be a current price, which is how we would get nominal GDP. This will be discussed later when we do our calculations. We're also looking at final goods, which means that intermediate goods do not count towards GDP. Only final goods are going to count. It means that if you are building a computer and that computer is only half built, then it doesn't count towards GDP. But if it is fully built, then it will count towards GDP. We see that this is measurements within a country. we've already talked about the difference between GDP and GNP. So we already know that GDP means within a country. And it is in a given period of time. Of course, that means that GDP is a flow variable. It's measured in dollars per year. Whether we're talking about real GDP, measured in constant prices, or nominal GDP, measured in current prices, we are looking at some sort of units that are dollars per year. Remember, this is that exception to the rule. Remember, if you want to spot a nominal variable, you simply look for a currency. But you might also recall during the lecture on variables, I explained that there is an exception to the rule, and this is it. So real GDP is real, yet it is measured in dollars per year. So be aware of that. Again, you're going to be, clearly told that it is real or nominal GDP in almost every case. We know that income must equal expenditure. We learned this with the circular flow diagram, that if I spend money, all of that expenditure is going to turn into somebody's income. This leads us to 3 ways of calculating GDP. We can use the expenditure-based method, or the income-based method, or the value-added method. The expenditure-based method means that we're going to calculate or count up all of the expenditures that people make on goods and services. And how do we do this? Well, we simply look at tax receipts. So the government is going to receive tax information from all of the businesses in Canada, and they can simply add up the revenues. These are the revenues that were generated. We're talking about gross revenues in this case. That's everything that people have spent on goods and services. We can also use the income-based method. This is where the government uses the tax information from individuals looking at their incomes, right? Everybody's got to report their incomes. So you would look at the individual tax receipts. And, of course, these 2 values, expenditure and income, are going to yield the same result, all right? The number is going to be the same. Now, it is a little bit off, right? They're not totally equal in reality. In theory, they have to be equal. But in reality, there is some discrepancy in exactly how people report their income. So, we find that when we actually look at the numbers, that they're a little bit off. The other way is to use what we call the value-added method. And this is where we look at each level of production, each stage of production, and ask ourselves, well, how much value has been added to this product? So you could imagine that there is a tree in the forest. Now, if we ignore the existence value of that tree, the environmental value of that tree, we could say that that tree currently has no value. So that's kind of a simplifying assumption in order to understand the value-added method. So there's this tree that has no value right now. And then a lumberjack goes into the forest and cuts down this tree and pulls it to the sawmill. What that lumberjack has done is added value to the tree. Right? By cutting it down, it's now somewhat available as a resource, or as a usable resource, and it's been transported to the sawmill. So this now has value. We'll say that it has $1,000 worth of value now. And then it's going to be purchased from that lumberjack for $1,000 by the sawmill. And what the sawmill is going to do is it's going to add value to that tree by cutting it. Right? It's going to cut it into different types of wood that is good for construction. So we're going to end up with 2x4s and 4x4s, and they're also going to make plywood, and they're going to make chipboard and different types of wood products that are ready to be used by other people. So they add $2,000 worth of value to this tree, which means that the value added, $2,000, is going to be added to the $1,000. So now this lumber, it can be sold for $3,000. Now we could imagine a carpenter is coming to pick up all of this lumber. And this carpenter is going to build a house. So they are going to add value to this lumber by putting it up in such a way that it makes a house. They're going to construct a house. So they add, we'll say, $5,000 worth of value to the lumber that we currently have, which means that the value of the house is going to be $1,000 plus $2,000 plus $5,000. So the value of this house is now $8,000. So this is how we can use the value added method. So each level of production is adding value to the initial good. So this is how our production is used, right? So we have the GDP, the gross domestic product. This is essentially what we would call our production, which is the same as our income, which is the same as our expenditure, you might recall. So what is our production? Well, we can produce consumption goods. We can produce investment goods. We can produce government expenditures. Or we can produce net exports, right? So this is our open economy accounting equation. And you might remember the percentages. So consumption is 57% of our economy. Investment is 23%. Government purchases are 21%. And net exports are negative 1%, which means that we import a little bit more than we export. We can see that 31% of our economy is exports and negative 32% is imports. So actually Canada, about 1/3 of our economic activity is trade. You can see how important trade is to Canada. So what is the different components and how do we calculate them? Well, consumption is spending by households on goods and services with the exception of purchases of new housing. Right? So, when we're thinking about this definition of consumption, it's essentially everything that you buy. Everything. Unless, when you say it's a new house. If it's a new house, then it will fall into the category of investment. Investment, in addition to the purchase of new housing, is spending on capital equipment, inventories, which is important. That one's a tricky one. We'll see in an example coming up. And different types of structures, i.e. buildings, roads, bridges. These are all capital purchases. Now, the interesting thing about doing this accounting is that it often depends on who is buying the good, which determines whether it's consumption or investment. So it's not necessarily the good. For example, if you purchase a computer, it's going to be counted as consumption. However, if a business purchases a computer, it's going to count as investment. Right? So notice how the accounting difference comes about based on who is purchasing the good. Another interesting aspect here is about what we call the intermediate type of good. So when you purchase a bag of flour, that is considered a final good. And when a bakery purchases a bag of flour, that would be considered an intermediary good. All right, so notice the difference in how things are accounted for. We'll see some examples of this later on, and there's certainly some examples within the textbook. Government expenditure is the expenditure by all levels of government. So the federal government is going to purchase things. They're going to have to purchase paper. They're going to have to purchase services. They're going to have to purchase hotel rooms and flights to go to conferences. And this is going to be expenditure at all levels of government. So federal, provincial, municipal. Municipal is your local. So, the mayor of Vancouver, that's a municipal position. And then we have net exports, which is simply the difference between exports and imports. So this is known as the trade balance. So let's do a couple examples here. So I want to know which components of GDP are affected and by how much. So I've got Tony who spends $200 on dinner with his friend. Well, in this case, we're going to see an increase in consumption by $200. So, of course, that means GDP is going to be increased by $200. Okay, notice that I've talked about the component. What do I mean by component? Well, consumption, investment, government expenditure, or net exports. Jane spends $1,200 on a computer to use in her editing business. She got last year's model on sale from a local manufacturer. So this one's a tricky one because we have to look at 2 years worth of GDP. So the first thing that we want to notice, we want to think about our definition, right? Remember, GDP is about is about production of goods and services within a given time period. In this case, we look at the year. And we're looking at, of course, those final goods and services. Well, this computer was produced last year. So we can say that last year there was an increase in investment of $1,200. Now, why is this an increase in investment? Because this computer stayed within the inventory of the company. All right, so the company produced this computer. They did not sell it last year. Therefore, it is in their inventory. And remember, inventory is a type of investment. Now, this year, nothing has been produced. Which means that we know that the GDP change should be 0. Now the trick here is to figure out how do we get to 0 by looking at the components of GDP. And the way that we do this is we say, well, Jane is going to increase her investment by buying this computer. She's increasing her investment by $1,200. And this is investment because Jane is buying this computer for her business. And with respect to the computer manufacturer, we see that their investment is going down by $1,200. That is, they are getting rid of inventory. Last year, their inventory was up by $1,200 because they have this computer basically at their store. And this year, their inventory is going down by $1,200 because that computer is now being sold. Notice that with this mathematical operation, we have an increase of $1,200, a decrease of $1,200, meaning that the GDP change for this year is zero, as we would expect because this computer was not produced this year. It has already counted as last year's GDP. What happens if General Motors builds $500 million worth of cars, but consumers only purchase $470 million worth of these cars? Well, in this case, we have two components of GDP being affected. Consumers are going to have an increase of $470 million worth of consumption. And the investment is going to be $30 million because General Motors now has $30 million worth of cars in their inventory. So we see that these two components make up the $500 million worth of production. The government transfers $200 to a poor family. In this case, there is no change in GDP because nothing has been produced. So in order for something to count as GDP, there must be an exchange of money for a good. So when we pay our taxes, that is not going to count towards GDP because we are just transferring money to the government. And when the government transfers money or gives money out for different programs to different levels of government as well as different individuals, these transfers do not count as GDP. The people receiving these transfers, if they spend that money on something, then it will count towards GDP. So if the government gives $200 to a poor family, that in itself is not a change in GDP because nothing has been produced. But once that family purchases perhaps some food, then that purchase of food will count towards GDP. So this is an important thing in our calculations. Transfer payments do not count. Yuki, we'll assume, is a Canadian citizen, buys a $1,000 clock that was manufactured in Germany. In this case, again, we have two components to think about. So for Canada, which is what these questions are based on, the Canadian GDP, we know that the Canadian GDP has not changed because this clock was produced in Germany. So Germany has had an increase in their GDP of $1,000. However, in Canada, the GDP change is $0, right? So we can just look at this in general. But this question is asking about the components of GDP. So once again, we have to ask ourselves, how do we look at the components of GDP in order to get to this value of $0? Well, Yuki purchases this clock, which means that consumption in Canada goes up by $1,000. But because this is an imported good, net exports decreases by $1,000. So $1,000 increase in consumption, $1,000 decrease in net exports. This is how we get to a Canadian GDP of $0 change. What if Alberta sells $40,000 worth of crude oil to the United States? Well, in this case, Canada is just simply exporting $40,000 worth of crude oil. So we get an increase in net exports of $40,000, which means that we have an increase of GDP of $40,000. Now, when measuring our GDP, calculating our GDP, we do not calculate certain things, i.e., they are missed. So, what are the things that are missed? Household production. That's one of the bigger ones. So again, when you produce something for yourself, it is production. However, it will not be measured. So in order for something to be measured, money must be exchanged. And to give an example, imagine that you are going to have a steak dinner this evening. If you're going to have a steak dinner, there's two options. You can either cook yourself a steak dinner, or you can go to a restaurant and have that steak dinner cooked for you. I guess I should start with saying in either of these cases, a steak must be purchased. So both are contributing to GDP. You buy a steak, or the restaurant buys a steak. Let's just say that the price of that steak is the same regardless of who you are, restaurant or doing it on your own. So GDP has increased by the same amount in both cases. And then you need to cook that steak, which means you have to turn on the oven, turn on the stove, and we'll just say again, that the increase in GDP from purchasing the energy required to cook that steak is the same. Right? So in both cases, the GDP has again risen by the same amount. And then, of course, you're ready to eat that steak. But one more step is required when you go to the restaurant, and that is you are going to also pay for the person who has cooked your steak. So you're going to pay more at the restaurant, whereas you don't have to pay any more for your own cooking. So notice that when we eat steak, if you cook it for yourself, the actual contribution to GDP is lower than when you have somebody else cook that steak. Because when somebody else cooks that steak, you're also paying for their labor. Now, this is the case regardless of how good the steak tastes. If at the end of the day the steak tastes the same, if you're just as good of a cook as a chef at a restaurant, then you ultimately end up with the same product. But again, going to the restaurant means a higher GDP. So GDP is not, absolutely perfect. We've already seen that when we look at this household production. There's also the underground economy. So this is where people purchase goods and services that are not accounted for. Right? So I give somebody money and they give me some sort of product. However, the transaction is not recorded. And if it's not recorded, then that means the government is not going to include it in GDP. This could be for, legitimate goods. Right? So people do engage in transactions where they simply buy a product from somebody and, ultimately that person does not record the number. Right? They don't actually record it in their tax filings. So basically you could imagine maybe you're friends with somebody that owns a restaurant, and when you go in to eat, since you're such good friends, the owner of that restaurant simply says, don't worry about charging them for this food, just give it to them. But then later on, you meet up with your friend and you're like, hey, thanks for that dinner. Here's $50. And that person just takes the $50 and puts it in their pocket. Right? So there's nothing illegal about food, but the fact that you're not recording the transaction means that you're part of an underground economy. Or, of course, it's going to be the case for anything that is illegal. So, go 2 years back and marijuana was illegal. So you had to buy it from a drug dealer, and certainly that was not recorded. So buying illegal goods clearly is not going to show up in the GDP calculation. We also see things like health and life expectancy not included. So these aren't factors, although we already know that health and life expectancy are related to GDP per person. So remember from earlier on when we look at productivity that there is a correlation, but it is not directly measured. We don't directly measure leisure time, but again, this is something fairly highly correlated with GDP per person. Same thing as environmental quality, same thing as political freedom and social justice. Sometimes this is correlated with GDP per person, other times it's not. So these are things that we might end up missing. And there's some things that get counted in GDP that are actually bad for humans, right? So when we have some sort of disaster, whether it be natural or anthropogenic, this may cause the GDP to increase because people need to, clean up that particular disaster, and therefore it has a positive impact on GDP. Prison systems, prisons need to be built. We need to hire guards in order to, keep these prisoners from getting too dangerous and rioting within the prisons and escaping. So we need to hire people in order to keep these individuals incarcerated. This doesn't necessarily make people's lives better, right? But it does add to GDP. And same thing with hospital visits, right? So sometimes we're going to the hospital and there's not necessarily something that can be done. And sometimes it's just better to not have to go to the hospital. So these kind of things don't necessarily make our lives better. Although, again, hospital visits can be debated depending on which side of things you're looking at. We've seen this chart before. This is a relationship between GDP per person and other variables. So as I just described, the higher GDP per person is, generally the higher your life expectancy is, your adult literacy is higher, environmental quality is often higher, leisure time is higher. So just quality of life is higher when we have a higher GDP per person. So if you take a course in resource and environmental management, you'll find out that this is, generally true, but there might be better measures, such as the quality of life index. So there are other measures that can be used instead of GDP per person. But right now, GDP per person is actually a very reliable measure. It's easy to measure, which means that measuring it doesn't cost a lot. It gets measured because we can get our tax information immediately. So the government collects tax information every year. So let's start to talk about real GDP and nominal GDP. When we're calculating these, we're calculating all production, right? So we're going to basically be looking at everything produced within the economy. And the way that we do this is we take the price of some good and multiply it by the quantity of that good. So the price of apples multiplied by the quantity of apples. The price of bananas multiplied by the quantity of bananas. And we do this for every good in the economy. Essentially, we're taking the price multiplied by the production basket. That's an easy way to think about it. It's not mathematically precise, but for a qualitative interpretation, a nice little metaphor of things, this is a nice way to think about it. What is the price of my production basket? right? How big is my production basket? So let's take a look at real versus nominal GDP. So real GDP, we're going to measure the prices using constant prices. That means that we're going to take the price in what we call a base year and multiply it by the price of the basket in the current year. I'm going to use base year prices and multiply it by current year basket. Now, if we look at this, we see that the value of the real GDP is only going to change because of the size of the basket. This is why it is real GDP, right? Real GDP equals a price which is going to be constant. The same prices are used over and over and over again, and the basket, i.e. the number of goods and services being produced, is the only thing that's changing. So the basket is what is real, right? And that's the only thing that's changing. This is why we call it real GDP. All right. So the real GDP measurement does not include inflation. That's where the nominal thing part comes in. So let's just take a look at this to make it clear. So here my base year is 2012. So I have the 2012 prices, and I'm going to just start with the basket in 2012, although I could use 2012 prices and go all the way back to 1999 basket, 1999, 2000. So it doesn't matter which direction I move, but let's take the 2012 basket and multiply it by the 2012 basket. Now, if I wanted to get the 2013 real GDP, I'm going to take the 2013 basket and multiply it by the 2012 prices. So notice that the only thing that's changed here is the real amount of production. Therefore, I'm getting real GDP. In 2014, I'm sticking with those 2012 prices. So again, this is where we get the idea of constant prices. And we see again that the only reason GDP has changed is because our real level of production has changed. These are real goods that are increasing. And we can continue on through the different years. So this is what we mean by real GDP. Looking at nominal GDP, we are going to use the current year multiplied by the current year. So nominal GDP changes because the prices change. Oh, the prices change? Well, changing prices, that means nominal. And the basket is changing. So when we see a change in nominal GDP, that change comes about because prices and the basket size have changed. That's what makes it nominal, because we are including the inflation. 2012 times 2012. Interestingly, notice that the base year nominal GDP and the base year real GDP are exactly the same value. They're both 2012 times 2012. But when we go to 2013, notice that I'm using bigger prices multiplied by the increase in the basket. Go to 2014, again, my price has increased, as well as my basket. So nominal GDP is growing because both price and basket are growing. Now we go into 2015. So using these two values, nominal GDP and real GDP, we can measure the ratio of nominal GDP to real GDP. And this ratio is essentially the weighted price ratio from different years. So essentially, when we look at the nominal GDP divided by the real GDP, you will notice that we've got the price, the current price, multiplied by the current basket divided by a constant price multiplied by a current basket. So this current price, current basket divided by constant price, current basket, in a virtual sense, the basket is canceled out. All right, not in a realistic mathematical sense. So this is not mathematically precise what I'm saying, but as far as a concept, when you're thinking about the GDP deflator, it is essentially telling you about a price level. And that price level is essentially price divided by price, right? Again, not exactly, virtually. So, let's take a look at what I mean by this. Here we have the here we have the nominal GDP and the real GDP. And the GDP deflator is going to be nominal divided by real. Now, if we look at the nominal GDP and the real GDP in our equation up here, which again is not really mathematically precise, but in a virtual sense, and that's important that you understand what virtual means. In a virtual sense, we see that the current year basket and the current year basket are virtually canceling out, which means that we end up with the current year price divided by the base year price. Now that doesn't mean that we just add up prices. It is again a weighted ratio. But if you're trying to remember, what the formula is, this can help. Because you know that at the end of the day, like when you're doing your calculation, that you must have the same basket on the top, i.e. the numerator, as you have on the bottom, the denominator. So let's take a look in our visual here. Here we've got the price in 2012 multiplied by the basket in 2012 divided by the price in 2012 multiplied by the basket in 2012. So this, of course, is my base year. 2012 is my base year. And when I do this calculation, well, that's going to give me 100. Right? So we're not going to worry about showing that calculation or that cancellation. But notice that when I move to the deflator for 2013, the deflator for 2013 is going to have the 2013 price multiplied by the 2013 basket. That's my nominal GDP for 2013. And my real GDP is going to be the 2012 price multiplied by the 2013 basket. And again, virtually, we can see that the basket on the top is the same as the basket on the bottom. So in virtual terms, they cancel out. Meaning that I've found a price ratio between 2013 and 2012. Same thing for 2014. We end up with a price ratio of 2014 divided by 2012. And in 2015, we go through the same process. We end up with a price ratio of 2015 over 2012. Now, again, that doesn't mean that when you do the calculation, you can just ignore the size of the basket. You still have to put the basket in, but this again is just to help you understand, what we are getting at the end of the calculation. Right? So mathematically, you cannot just ignore the basket. You need to have those quantities in your calculation for a deflator. But this should help you understand what the result is. And of course, from that information, we can get the inflation rate. So we've got the deflator from year 2 minus the deflator from year 1 divided by the deflator from year 1. And some of you may recall from our percentage changes that we don't need to do all of this calculation. One of the things that we can do is obtain the factor change and just convert it into a percentage. That is, I can simply take the GDP deflator from year 2, divide it by the GDP deflator from year 1. That will give me a factor change. And that factor change we can convert to a percentage change. We've done this now with our production equals productivity multiplied by population. We've done this with our VM equals PY. And we can use the same percentage change calculations for this. So let's do a quick numerical example. Here we're going to use 2013 as the base year, and I want to calculate the nominal and real GDP, the GDP deflators, and 2013 inflation. Notice that I've already put in the deflator for 2013 because it is always 100. All right, the base year always has a deflator of 100. In order to get my values, one of the things that I sometimes like to do is circle the price for the base year. That just kind of reminds me of the prices I need to use for my real GDP. First thing I'm going to do is calculate my nominal GDP for 2012, which is 100 multiplied by 10 plus 20 multiplied by 50. All right, so I need to do the full calculation. The next thing that I can do is calculate my nominal GDP for 2013. So 110 multiplied by 12 plus 22 multiplied by 55. And that's going to give me 2530. This, of course, is going to be my real GDP as well, because this is the base year. And notice that 2530 divided by 2530 is what gives me the value of 1. And when I'm talking about deflators, I want to multiply my value by 100. So that's where I get the 100 from. Moving on to the real GDP of 2012, I've got the prices in 2013, 110 multiplied by 10 plus 22 multiplied by 50. This gives me 2200. And in order to get my deflator for 2012, I'm going to take the nominal and divide it by the real. So 2000 divided by 2200, and I multiply that value by 100, which gives me 90.9. If I want to get my inflation, I can simply take 100 minus 90.9 and divide it by 90.9, and that's going to give me 10%. Notice, very important, when I want to get the 2013 inflation, I am taking 2013 value and dividing it by the 2012 value. All right, that's my 2013 inflation. So, when we ask for inflation, the year that is asked for is the second year. Now, of course, some of you might be thinking, why did I do it this way? And I would say, excellent observation. An easier way to do this, a quicker way to do this, would simply to take the number 100 and divide it by 90.9. And if you do that, you will end up with a value of 1.1, which of course we have learned if the factor increase was 1.1, then that means that the percentage increase was 10%. And you probably should have calculated the 2014 on your own, but you can go ahead and do this and see that you get these numbers. Nominal, 2990, real, 2860, And that means that we have a deflator of 104.5, which means that my 2014 inflation would be 104.5 divided by 100, which gives me 4.5%. So why is all of this necessary? Well, the problem in economics is that prices change over time. But prices are also our units of measurement. This is the problem in economics, right? I don't care about nominal values. I care about real values as an economist. And my measuring stick, prices, are constantly changing. This is a strange thing. It's the only discipline in which the measuring stick changes. Imagine that you are a biologist and you've got a ruler and you want to measure the height of a tree. Well, if you measured the height of this tree back in 1990, you would have measured it with this ruler. And we can see that the tree is 0.5 units tall, right? We could say 0.5 meters if we want to put an actual value on that, an actual specific unit. So let's say 0.5 meters. And then in the year 2020, I decide to go and measure this tree again. Well, the tree has grown. And in measuring this tree, I see that the tree height is now 1.25 units. The thing that we can notice here is that the size of my measuring stick has not changed. A meter is the exact same length as a meter in 1990 as in 2020. Now, in economics, if we were to make an analogy, remember that what does inflation do? Well, inflation reduces the value of money. It reduces the value of a dollar. That is no different, if we were biologists, if the value of a meter was reduced over time. So if we wanted to go with this analogy, this is what's happening in economics. Notice that the value of our meter stick is getting smaller. And then we go to measure that tree and it says that it's 4 units. Well, the tree has not grown from 0.5 units all the way up to 4 units. The problem is our measuring stick is getting smaller and smaller over time, and this is because of inflation. So it makes things look like they've grown much more than they really have. So we need to figure out how to actually, make our measuring stick constant. And we do this by getting GDP deflators. Once we have the deflator, we can convert our units from nominal to real or from real to nominal. All right. This is basically the conversion unit that can take me, from 1 meter stick to another meter stick. If I was to use the exact same measuring length, it doesn't matter which year I choose, right? If I was to use the exact same measuring stick for my measurement, we see that we're going from 1.6 units up to 4 units, or I'm going from 0.5 units up to 1.25 units. Now, if I go with either one of these, I can see that the tree has grown by 2.5 times. So the deflator, we can convert nominal variables into real variables, or we can convert real variables back into nominal variables. That's what the deflator does. It essentially makes it so that we can convert our nominal to real or real to nominal. And we'll find that this is the same thing with our CPI. So our CPI is essentially the same thing, except we're using a different basket. Right, so we'll get to that in the next lecture. But again, the concept will be the same. Right, so convert nominal to real or real to nominal. So let's go ahead and take an example here. So I simply want to take these values that we have in this table and complete the table. Again, I think we should get used to using our factor changes. So this is an excellent practice for you. If you want to pause the video and try to do these, you certainly can by filling in the blanks. But I'm going to go ahead now and start showing you how I would do this. So firstly, I would say that my deflator, remember, my nominal GDP divided by my real GDP is going to give me my deflator divided by my deflator is going to give me my inflation. So for the first one that I'm going to do is going to be between 2008 and 2009. And 93 divided by the 2008 number, which I've labeled as X, should give me a value of 1.0333. So what I've done is I've taken that percentage increase of 3.33 and I've converted it into a factor increase of 1.033. This means that I find out that X is going to be 90. Then I can go ahead and get my inflation for 2008. Listen to what I just said there. I'm going to get my inflation for 2008. My inflation for 2008 will be 2008 divided by 2007. So, here's the long way of doing it. I've shown the entire equation. However, hopefully what you did was simply take 90 and divide it by 88. If you took 90 and divided it by 88, you would have gotten 1.0227. And of course, you would have then said that is a 2.27% increase. Right? So, really want you to get used to the idea of percentage changes and factor changes. In general, using the factor change is way quicker, and you will also make fewer errors than if you try to do everything with percentage changes, right? You're basically reducing the number of steps. You're also reducing the possibility of making errors. So I really encourage you to understand how factor changes and percentage changes are related. We can continue on. 95 divided by 93 gives me 1.0215 or 2.15%. Our next value for 2011 would be 97 for the deflator. 3.09% for the 2012 inflation. 3.09% is the 2012 inflation. We're going to need to drop down because there's not enough information in that large gap there. So there's a lot of information missing. So we can go down to 2014 and get 106. We can then fill in our 2013 deflator. And then we can fill in our 2013 inflation. Finally, we end up with 113 divided by 110, giving me a 2.73% inflation rate for 2016. Now, using the information in this particular table, I want to calculate the Well, I want to calculate some values here, nominal versus real. Let's imagine that biologists were paid an average of $40,000 per year. If biologists maintained their purchasing power, how much did they earn in 2014? So what I'm saying here is that if the nominal income was $40,000 per year, what would the nominal income have to be in 2014? Now, comparing these two, that basically means that the real income has to remain constant. So I'm trying to figure out how to maintain a real income that is constant. Well, here's one way to look at it. We've got the wage in 2008 divided by the wage in 2014 is equal to the price level in 2008 divided by the price level in 2014. Now, this can be converted, and I actually like this second, or I guess third piece of information here, that my wage in 2014 is going to actually be based on the percentage increase in prices between these two time periods. So the price level in 2008 was 90. That's essentially the price of a basket of goods. And the price level in 2014 was 106. So if prices have gone up by a certain factor, and that factor is 106 divided by 90, if the prices of goods has gone up by that factor, then I'm simply going to take that factor, multiply it by 40,000, and that's going to give me $47,111 per year. So I want my wage to go up by the same factor as did prices. So making $40,000 in 2008 will buy me a basket of goods, and making $47,111 in 2014 will buy me that same basket of goods. That is, my real income has not changed. And of course, we can look at our concept that we've already seen in the velocity equation. Remember that price times real GDP, P times Y, is nominal GDP. And that's what we have here. We have price, P, multiplied by real GDP, Y, is equal to nominal GDP. So what I can do is I can take all of these values and just follow the formula. If I may have a real GDP of $205,000 per time period in 2007, and my GDP deflator is 88, so I'm converting things into, that 2012 base year, I can simply take the price level, which is 0.88. So remember, when we did the price level, we multiplied by 100. Now, that was just an arbitrary type of calculation. So in this case, we need to just remove that multiplied by 100. So we have 0.88 multiplied by 205,000, which means that my nominal GDP in 2007 was 180,400. So you can do the second one in the exact same way. And that's going to give me 191,700. Moving on to 2009, we're simply going to reverse that calculation. So here I've got 203,670 divided by 0.93. That's how I'm going to get my real GDP, 219,000. Again, we see a similar calculation for 2010, and then of course 2011, and so on. Here we go 1.03 is my factor increase. So this is how I'm going to be doing my calculations. So remember that GDP has four main components: C, I, G, and NX. Of course, that is for my open economy. If it was a closed economy, it would be C, I, and G. We saw the deflator is used to calculate inflation using goods produced by a nation. Remember, we're trying to get a price ratio, which means that the basket that you use on the top, i.e. the numerator, must be the same as the basket that you use on the bottom, i.e. the denominator. If you can remember that, if you can remember that you're trying to get a price ratio, then you should be fine with the calculation. You don't have to memorize a formula. Understand the concept. And if we really want to make comparisons over time, we need to convert everything into real variables. Nominal variables just don't do it. Imagine a country that experiences no real growth but has high inflation. Well, if we look at nominal variables, we might say, hey, this country is doing better. That is, imagine that the nominal GDP has increased by 10%. But inflation is also 10%. Essentially, that country has not grown in real terms at all. But nominal GDP says, hey, this country has grown. So we need to convert everything into real terms. And we can do this by getting GDP deflators. Choose your base year and get your GDP deflators based on that base year. I'd like to thank Pixabay as usual. This is where I got most of my images. So a place where you can get free images. You still want to put some sort of reference in if you have retrieved these. Thank you for listening to this lecture. I hope you've learned something. Take care, everybody.